Downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, usually fiscal stimulus and monetary stimulus follow pretty quickly. In my career, during most difficult times in the market, recession times, I know there's a big debate as to whether we're in one or not. And I know there are perhaps political dynamics at work suggesting that no one wants a recession in a midterm election year. But we believe we're in a recession, and I think the evidence is accumulating that the statistics that we're getting fed day to day and to which the market reacts so violently may be very distorted by seasonal factors. And I'll get into that in a moment. But if we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. It means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. As I mentioned earlier, we had a nice rally. Some were calling it a bear market rally. 23%, I think, on the S&P 500 from mid-June to mid-August. And now we're giving back. We thought one of the reasons for that rally was that the Fed was going to pivot, and that the market, seeing the deflation in the pipeline, assumed that the Fed would start talking about that deflation. Instead, we got Jackson Hole, and now the market's relapsing. We do think we're in a bottoming phase here because we think we're going to see a lot of deflationary signals that will, at some point, get the Fed to talk about them. It doesn't want to talk too soon. It doesn't want to give anybody any indication that it's anywhere near pivoting. It wants to sound very hawkish, wants everyone to believe that they're going to be as tough as Volcker was in order to get to 2% faster than would otherwise be the case. You know, it could be a lot less than 3% if some of these big retailers start slashing, they need to, prices in order to clear the shelves and put in holiday merchandise. So we'll see in the next few months. As to markets now, so starting with equities, we've talked a little bit about that. As usual, equities are very dependent on a couple of things: profits and valuations. Now, we think profits are going to be hit hard here. More the cyclical part of the world. Our strategies are not biased cyclically. If anything, they're biased completely in the opposite direction. And they tend to do well when overall profit margins are coming down. Now, profits in the GDP accounts looked like the early indications were that they were down significantly quarter to quarter in the second quarter. It seems as though they moved up to an all-time high. What I have found with these metrics around turning points, these metrics and especially employment, is the revisions. If we're really in recession, the revisions are extreme. If you listen to all of the companies reporting, you would not believe that profits are up. Many of them are down in a very big way. So again, this dependence on economic indicators, which may be distorted by seasonal factors gone wild during COVID and an inability to adjust them accordingly, could be distorting some of these numbers. The second variable, valuation, very dependent on interest rates, which in turn are dependent on inflation. And you know what we think. But the bears think we're going back to a 70s style inflation and valuations dropping to those levels. That is the essence of the fight taking place, this tug of war as we try to bottom up in the market, bottom out. I do think Europe's in recession. I think China's in recession. So the US really is the swing factor here. On a year-over-year basis, gold prices are down 10%. And I'll end right now on talking about the impact of innovation on inflation. We are seeing artificial intelligence training costs dropping 60% per year. That in the industrial robotics space, that rate is 51%. In the battery space, it's 28%. In the DNA sequencing space, it's 28% for short read and 40% for long read. So we're seeing deflationary forces that are beginning to matter. You know, electric vehicles now, it depends where you are. In China, they account for battery electric vehicles, not even including hybrid, account for 19% of all sales. In Europe, it's 10%. In the US, it's closer to 5%.